All right, so chapter 7, if you look at page 232. All right, chapter 7, if you look at page 232, the first question says Fowler just paid a dividend of $2.55. Okay. This is kind of important because the questions here will either tell you information. In this case, it's telling you that the last dividend paid was $2.55. Now, a lot of times in other questions, it'll say something like next year's dividend is expected to be something. Well, that's completely different. So the last dividend paid was sort of like it was paid yesterday. And if it was paid yesterday, then that $2.55 is just information that we use to try to figure out what's expected to happen in the future. So it's kind of like if we were looking at, hey, how many wins do we think the Cardinals will have next year? We might have looked at last year as kind of a benchmark. And that's the same concept here. So if we want to try to figure out what's going to happen in the future, we often look at the past. And so in this case, it said the last dividend or just paid a dividend of $2.55 a share. It's expected to grow at 3.9%. So what does that mean? That means we can start to figure out what the next dividend will be. So if the last dividend was $2.55, it's expected to grow at 3.9%. That tells us that D1 is going to be $2.65. Then we could figure out D2, D3, D4, etc. Okay. Since this is a constant growing perpetuity, we can use this equation, which is our constant growing perpetuity equation. Oops. Okay. Which basically says the price at any time t is equal to the cash flow at t plus 1 divided by r minus g. That was only true if r is greater than g and growth is constant and perpetual. And this is exactly what we have in this sort of simple problem. So it says, hey, if I want to find P0, I need the cash flow at 0 plus 1, or I need D1, and I need to divide it by R minus G. So I take the $2.65, divide it by the required rate of return, which was given at 10.4%, minus G, which is 3.9%. We've got a P0 at 40.77. All right, remember, if you have a question, the best way for me is just unmute yourself and ask, because I can't see the chat function. All right, now the next part of the question said, what will the price be in 3 years? So if we're looking for P3, and because I'm getting better, I'm going to change colors. All right, so if we're looking for P3, the price 3 years from now, then we've got to find the present value of the cash flows in year 4, 5, 6 to infinity. And we really need to find the price at the beginning of year 4, and the beginning of year 4 is the same as the end of year 3. So the price 3 years from now, P3, is equal to D4 divided by R minus G. D4 you could find the long way just by going D0 equals D1 times, or D1 equals D0 times 1 plus G. We could kind of go through. D2 equals D1 times 1 plus G. D3 is equal to D2 times 1 plus G. But what you can see is it's a lot easier sometimes. If you want to find D4, I'll go ahead and write it down. Okay. D4, okay, is really equal to, if you back your way through it, D3, D2, D1, okay. D4 is really equal to D0 times 1 plus G to the 4th. And so an easier way to find it is if you know D0 and you know the constant growth rate, you could do it the long way, but the easier way is just take it times 1 plus G to the 4th, and that's a much easier way to get it. Once we have D4, we can divide it by R minus G, and in other words, we found P3 because P3 is equal to D4 divided by R minus G. All right. So the stock's expected to sell at 40.77 today. 3 years from now, it's expected to be worth 45.72. And if we wanted to find the price 15 years from now, if we wanted to find the price 15 years from now, and if we want to find P15, we're going to need D16, 17, and so on. But really, to find P15, we just need D16, R and G, which we have. So the price 15 years from now is expected to be 72.36. All right, let's stop here for a second. Any questions about the first problem? Scrolling through, I don't really see any. All right, let's go back to the next problem. So as we look at problem 2, go back to my different color. All right, so now if we look at problem 2, it says, hey, the next dividend by Hoffman will be $2.65. So this is important because what? The reading of the word in the question says not the last dividend paid, but the next dividend is expected to be $2.65. They're expected to grow at a constant rate of 4.5%. And now the question says, if the stock is selling for 43.15 today, what does that imply about the required rate of return? So we need to go back to our formula. I'm just going to write it down here on the bottom over here, and then I'll erase it. But basically, if we remember, P0 equals D1 divided by R minus G, we can rearrange this equation. And therefore, we can figure out that R is equal to D1 over P0 plus G. Okay. So that's how I got this equation, was just from an adaptation of our original constant growing perpetuity. And I'll need that space, so I'll go ahead and erase it. Oops. All right. So now that I have this equation, if I know D1 and I know P0 and I know G, it implies a required rate of return of 10.64%. All right. Now, if you look at problem 3, it's just an extension of problem 2. It said for the company in the previous problem, what's the dividend yield? Well, the expected dividend yield is just the expected dividend relative to the price that you pay. So this right here is the dividend yield. Okay. So the dividend yield is just the 265 divided by 43.15. The expected capital gains yield is just the growth in that the dividends are expected to grow, the constant growth rate. Now the constant growth rate implies that revenues are growing at a constant rate, the margins are the same, net income's growing at a constant rate, earnings per share is growing at a constant rate, and since everything is constant, the PE multiple would be constant. And so what that implies is that the stock price should also grow at 4.5%. Okay. If everything else in the company is growing at 4.5%, including the dividend, then that dividend growth rate also implies a growth in the stock price, okay, or the rate of increase in the stock price. So you can see here, if you require a 10.64% return, you're getting 6.14 from the dividends and 4.5 from the price appreciation of the stock. So you can kind of see it. If we go back to problem 1, we could have actually taken a little bit of a shortcut back at problem 1. If we knew that I'm going to change colors again. If we knew that P0 was 40.77 and we wanted to find P3 using a shortcut, we could have just taken the 40.77, and now knowing that G represents an increase in the price of the stock, if the growth rate was 3.9%, we could have taken 1.039 to the third and multiplied it by 40.77, and we would have gotten 45.72. You don't really know how to do that, but that's just kind of a proof back to show you that the growth rate implies what the price of the stock's going to increase over time at. Because that constant growth is basically an assumption that everything's growing at some constant rate. And you can see why we don't really use it much in practice, because that's a big assumption that everything's going to grow at the same rate. When in reality, things grow at different rates each year and can sometimes be negative. All right, any questions? over the first three problems. All right, so if you got a question, you need to unmute yourself. Or you can type it in the chat. I can see the chat now. Or you can raise your hand. I can probably see that too. All right, let's go ahead and look at the next one. All right, the next one's problem number 8. Problem 8 says Smiling Elephant has issued preferred stock that pays a $2.85 dividend. In perpetuity. If the stock's currently selling at $77.32, what's the required rate of return? Well, if we go back and remember, preferred stock is kind of a hybrid between common stock and bonds. One of the things that you have to know is that preferred stock has a face value that's assumed to be 100. Just like bonds have a face value that's assumed to be 1,000, preferred stock has a face value that's assumed to be 100. So when we talk about a preferred dividend, it could have been written as 2.85% as the preferred dividend, which would also imply that you're going to get $2.85 each year. And since this is perpetual preferred, you'll get it each year forever. Okay. So now we've got to find the equation to use to find the present value of a perpetuity that isn't growing. And if you remember, P0 equals D1 divided by R minus G. In this case, if growth is 0, then P0 is just equal to D1 divided by R. And if you want to rearrange it, R for preferred stock will always be equal to the dividend divided by the price. So if we have a $2.85 dividend and a price at $77.32, that's going to imply a return of 3.7%. Dividend divided by price. So preferred stock is kind of super easy in that respect because growth is always 0. So companies that pay a preferred dividend, you get the same amount each year, even if the company does better. Unlike common stock, which we're sharing in the profitability. All right, let's go ahead and look at number 12. Number 12 says Cape Corporation will pay a dividend of $2.64 next year. Now what that is they're expecting to pay $2.64 next year. Well, hold on, before I do that, any questions on the preferred stock?
No.
Okay. Well, let's go on to the next one. All right. So number 12, it said, hey, we expect this Cape company, Cape company to pay $2.64 next year. So that's already the D1. Just the wording of the question is important. It didn't say it just paid a dividend, it's expecting to pay one next year. It will maintain a constant growth of 4.5%. If you want a required rate of return of 12%, what would that imply in terms of the price? Okay. So we go back to our formula, P0 equals D1 divided by R minus G. And so at 12%, $2.64 divided by the 12% required return minus the 4.5 growth gets us 35.20. Now what they're trying to show you here is what happens if you require less of a return, or what happens to the present value of future cash flows at a lower interest rate. So if we drop the interest rate down to 8%, if we drop the interest rate down to 8%, how's that going to impact the present value of these cash flows? And at a required rate of return of 8%, plug that back into our formula, and we find out that now this stock is worth $75.43, or that's the most we'd pay if we only require an 8% return. So the less you require as a return, the greater the present value of the future cash flows are. So this is kind of an important concept, not to deviate off track a little bit, but this is an important concept because in essence, if you remember, during a point in time in which we're wanting to stimulate the economy, one of the moves that the Fed does is to lower interest rates. And so back in the financial crisis in 07 and 08, the Fed lowered interest rates. And by lowering interest rates, it was a way to stimulate the economy. Now, what happened and where people kind of got upset is once the economy got rolling, then the Fed started raising interest rates slightly, but it took a long time. And the worry was if you raise interest rates, you're going to depress asset prices, okay, and you're going to slow down the economy. And so even though it took a long time, back in 2017, 2018, the Fed began raising interest rates. And we saw a dip in the stock market by about 10% in December of 17, going into January of 18. And so that's kind of when the president and other people got mad and said, well, why is the Fed raising interest rates? And there was some controversy. And the issue was, why do you raise interest rates? You know, it's hurting the stock market. Well, you can kind of see now what happened. Had they kept raising interest rates, the stock market might have fallen a little bit because the present value of the stocks, or the value of the stocks, goes down as interest rates go up. But by doing so, it gives you some ammunition in case something unexpected happens, like a coronavirus. So what happened 2 weeks ago, when all this coronavirus started and the economy was slowing down, and now we've got unemployment at 20%, or expected to be 20% unemployment. What did the Fed do? Well, the Fed lowered interest rates, but it could only lower them by about 1.5% because the interest rates were already low and they didn't raise it during the economic boom time. So that's kind of one of the controversial things that you're seeing lately is we don't really have a way to stimulate the economy with interest rates because we kept interest rates relatively low, even though the economy was going strong. So you can kind of see where some of that stuff comes from. If you ever hear the term inflated asset prices, okay? So one of the things is everyone likes the stock market to go up. Well, especially the 1% that owns about 90% of the stocks, they like the stock market to go up. And that income inequality that came about was partially fueled by the Fed keeping interest rates artificially low. That was one of the one of the issues. And by keeping interest rates artificially low, they didn't have enough ammunition to be able to provide stimulus in case something unexpected happened. So that's, you can kind of see from this problem exactly what the arguments were. All right, any other questions? All right. If we look at number 13, number 13 says the Bloomington Flour Company has earnings per share of $3.68. The benchmark PE for the company is 18. Okay. So if you kind of look at it, the PE multiple is price per share divided by earnings per share. And if price per share divided by earnings per share is 18, that's where we see this PE multiple written as kind of shortcut form as just P over E. So if the earnings per share is $3.68, then we need to find what a P multiple of 18 would imply. Well, you can see why it's called a P multiple, because you're basically multiplying 18 by 368 to get P. And a stock that's trading at 18 times earnings, or a P multiple of 18, if their earnings per share is 368, then the price would be 66.24. And so if you go back, this PE multiple is a function of growth and interest rates. And so a higher PE multiple is higher growth, and a higher PE multiple also implies lower interest rates. That's not really for this class, but that's what we'd study if you take the investments class. So you can kind of see what's the appropriate PE multiple for a company. The appropriate PE multiple depends on the growth rate of the company and interest rates. A lot of times people forget about this part of it, and they basically assume the PE multiple is some sign of growth. A high PE multiple company has higher growth, and that's generally true, but it's not completely true. Okay. So you can see if somehow the PE multiple were higher, that is, the company had higher growth, and let's suppose the PE multiple for companies similar to this is around 21. If the PE multiple is around 21, this is what you'd call multiple expansion, that people now think the appropriate multiple is 21, then a price to earnings multiple of 21 would imply a price of 77.28. Whereas a PE multiple of 18 implies a price of 66.24. All right, let's look at 15 unless someone's got a question. I won't get off the screen. You just have to unmute yourself and ask. All right, what about stocks that don't pay a dividend currently? Doesn't mean they're not valuable. In fact, right before the coronavirus hit and sort of dropped everyone down, Microsoft, I don't know who the most valuable is now, but Microsoft was the most valuable company. It was worth over $1 trillion. Now, for a long time, Microsoft never paid a dividend. They do now, okay? But they didn't pay a dividend for a long time. Why not? Well, they were taking all the earnings and plowing it back into new projects, new ideas. So if you remember, Microsoft started out with this operating system. Okay? Some people say they copied it from Apple, but it was like a Windows operating system. And then they came out with applications like Microsoft Word and Excel and PowerPoint, and they developed new applications that worked on this operating system, and that's how they made all their money. Then they started doing what? Well, they plowed it into new ideas and new businesses. They plowed it into a MP3 player that didn't really work. They plowed it into cell phones, didn't really work. But they also built up other companies, and they built up like a cloud platform that generates a lot of cash. So they took the profits from one business and plowed it back into the firm so that the firm could grow. And some of the new businesses worked out and some of them didn't. And that's how companies grow and become better. You can kind of look at Apple. I mean, Apple's come up with a lot of new products. Some of them software, some of them cloud, some of them, earbuds. Some of them have worked out well, even though the phone was kind of the one that really put them on the map. But originally they started out with Apple computers, and then grew that into different things. And their new business getting into the phone, they took the profits from selling computers and put it into phones, and that's how they really took off. So companies that don't pay a dividend doesn't mean they're not valuable, just means they may not pay a dividend for a long time. Once they have enough money that they don't need all of the earnings to fund growth, then they'll start paying a dividend. So this one says, Metallica Bearings is a young startup. No dividends will be paid over the next 9 years because the firm needs to plow back its earnings to fuel growth. The company will then pay a dividend of $23 per share 10 years from now. So that's the first dividend that people are expecting. That's pretty hard to predict, but again, this is a canned problem. So you can get the idea. It's sort of hard to predict 10 years from now what the dividend will be of a company. But theoretically, it works out fine. Practically, it doesn't work out so well. That's why people like PE multiples that don't rely on dividends. But anyway, so the first dividend's 23, the growth rate's 5%, and the required rate of return's 12. So if we want to find the price of the stock today, remember, we're looking for the price today. Since this is the first dividend paid, we need to go back to the beginning of year 10. Okay, so the beginning of when this annuity starts, and the beginning of year 10 is the same as the end of year 9. So we really want to find P9, but P9 implies the price at the beginning of when the annuity starts. So the beginning of year 10 is the same as the end of year 9, so we just write it as P9. So P9 is what's referred to as our horizon value. So we're taking a constant growing perpetuity and converting it, all of this future dividends, into a single period cash flow. And the single period cash flow turns out to be $328.57. That is, P9 is equal to D10 divided by R minus G. R is 12%, G is 5. So P9 is our horizon value. But the question asks for the intrinsic value. And since we know what this stock will be worth 9 years from now, based on our estimates of the dividends from year 10 forward, we found P9, our horizon value. And if we want to find P0, we need to take this cash flow in year 9 and bring it back to year 0 by discounting it at 12%, the required rate of return for 9 years. So if you take 328.57, divide it by 1.12 to the 9th, you get 118.49. Or if you want to use your fancy calculator, it'll do those calculations for you. Just put in 328.57 as the future value with no payment for 9 years at 12% interest. Solve for the present value. And basically the inputs on the calculator are what's doing that mathematical formula. All right, any questions on 13 or 15? All right, let's look at one more. This is another kind of weird problem that you wouldn't normally see, but again, it's a book problem. It's meant to demonstrate something, not really show reality. It says, hey, suppose you expect this company to pay a $7 dividend a year from now, a $13 dividend 2 years from now, an $18 dividend 3 years from now, and I don't know why, but for whatever reason, in year 4, they're going to pay $3.25. And after year 4, the growth is going to be 5%. Okay? So if we want to set up our horizon value at the beginning of when the annuity starts growing at a constant rate, and remember, after year 4, it starts growing at a constant rate. So if we want to find it at the beginning of year 5, then our horizon value will be the price at the end of year 4. Okay? So even though it's really the beginning of year 5 is when the annuity starts growing at 5%, we can find the horizon value, and we call it not the beginning of year 5 price, but we call it P4. P4 is the end of year 4, the same as the beginning of year 5. So P4 is going to be equal to D5 divided by R minus G. Well, we don't have D5, but we do have D4, and we have a growth rate. And so if D4 is $3.25, then D5 would be equal to, I'm assuming I did the math right, 341. Okay. So now if we want to find the horizon value first, we need D4 divided by R minus G. We just calculated D4. We were given R. We're given G. We can find the horizon value. Okay. But remember, that's not your answer. We're not looking for the horizon value. We're looking for what? We're looking for the intrinsic value. We're looking for the value today. So if you think about it, you're going to get $7 a year from now as a dividend, $13 2 years from now as a dividend, $18 3 years from now as a dividend, and $3.25 4 years from now as a dividend. Plus, you've got a horizon value that we just calculated, 63.15. So if we want to find the intrinsic value, we need to find the present value of each of those cash flows. The present value of the $7 1 year from now, the $13 2 years from now, the $18 3 years from now. And this is important. We need to find the 325 and the horizon value, which is sitting really at the beginning of year 5, but we called it P4. The end of year 4 and beginning of year 5 are the same. So discount that back to year 0. And assuming the math is correct, add all those up. This should be 634. This should be 1067. This should be 1338. and these two discounted back to be 44.70. And that gives us 75.09. All right. Any questions on chapter 7 stuff?
All good here.
Yeah. Oh, good. Okay. Very good. All right. Now, remember, we got a quiz for chapter 7, and that quiz is due tomorrow at noon. We're also on Tuesday going to have a test. Now, the tests, let's see if I can. The test is going to cover stuff from chapter 3, which is ratios. Now remember, I'm going to make you memorize some ratios. I don't know if you remember or not, but the ratios I'm going to make you memorize are gross margins, operating margins, net margins, the P multiple, and earnings per share. Actually, I got the last two out of order. Earnings per share, then the P multiple. Those 5 I want you to memorize, and you'll see why. Those are the ones that we tend to use a lot, especially like in chapter 7. So what do we want to go over? Chapter 6, chapter 3. Anyone have any suggestions? All right. Well, I guess no suggestions. I'm going to go over a couple chapter 6 book problems, because we probably didn't do those. And I'll just go over a couple to kind of refresh your memory. Maybe. Uh, I don't know why it's not coming up. All right, let me try this. All right. Let's just get it open first. There we go. Moodle doesn't like it. There we go. All right, so if you go to chapter 6, the first book problem was number 6 in chapter 6. So I'll give you a second. I'm on page 199. All right, so chapter 6, book problem 6, page 199. It says Duffner issued 15-year bonds 1 year ago. So if we kind of look at this, remember, if this is 1 year ago, 1 year ago was 2019. So if they issued 15-year bonds, they're going to mature in 2034. So if we look at today, today is 2020. If today is 2020 and the bonds mature at 2034, that means since these were 15-year bonds a year ago, the bonds have 14 years left to maturity. So that's important. The coupon rate was 4.8%. So the coupon rate was 4.8%. Since we know the face value, unless otherwise stated, for all bonds is $1,000, that means the coupon payment would be $48 per year. But it says these bonds make semi-annual payments. What does that mean? It means they make 2 easy payments. So while you get $48 a year, each payment's going to be $24. So in 14 years, that will be 28 6-month periods. And each payment is going to be $24. And at the end of the life of the bond, you get the face value back, which is $1,000. And it does say the current price, or the current dollar, what is the current dollar price assuming $1,000 par value? Okay. So we're looking for the price of the bonds given the fact that the yield to maturity is 5.3%. If the yield to maturity is 5.3%, that's per year, then the interest rate we want to use, and that's also going to assume compounding at the same rate as the coupons. So that's 5.3% a year compounded semi-annually. So the interest rate per period, or the periodic interest rate, is 2.65%. And that periodic interest rate is what we want to use in our calculations. So if we look at it, we have $1,000 future value. We have payments of $24, of which there are 28 of them, and an interest rate at 2.65. And we want to solve for the present value. So we've got $24 payments. Put that in your calculator. We have 28 of these, $1,000 future value. and an interest rate of 2.65% per period. Solve for the present value. Solving for the present value should give you 951.02. Okay. So what we want to remember is to use the periodic interest rate. The periodic interest rate times some multiplier gives us a nominal rate. If the nominal rate's 5.3%, then we need to solve for the periodic interest rate at 2.65. That matches up our interest rate with our payments with our number of periods. All right, let's look down at number 7, then I'll see if we have any questions. All right, if we look at number 7 that said Parkway Void issued 15-year bonds 2 years ago. So if they issued 15-year bonds 2 years ago, the bonds have 13 years left to maturity. The coupon rate is 5.4%. That means the coupon payment is $54 a year. But we know most likely, and it says these are semi-annual. So the per period payment that we use for our calculation is 54 divided by 2, which is probably $27. So that means we're going to get $27 every 6 months, or $54 a year. But if we get $27 every 6 months, that's 26 periods. Okay, so this was 13 years, but every 6 months, that means there's 26 periods. So now that we've got the payments, the question they're asking is if these bonds sell for 106% of their face value, it means they're selling for $1,060. So now what we have, present value, negative 1,060, because that's what we're giving up. We've got payments of $27. We have 26 of these payments. We have a future value at 1,000, and we can solve for the interest rate. So if you put that in your calculator, 1,060 negative present value, $27 payments. There's 26 of them, $1,000 future value. Solve for I. I is equal to 2.39%. That is not our yield to maturity. That's a periodic interest rate. The yield to maturity is a nominal interest rate. So it's going to be equal to the periodic interest rate times the multiplier. The yield to maturity would be 4.78%. All right, any questions over, that was just kind of a quick review of the bonds. Any questions over the bonds?
No.
There's obviously more questions than that in the bonds, but it's kind of help you jog your memory just a little bit.
So far, our test is going to be chapter 3 and chapter 6
And 7,
and 7. Okay.
3, 6, and 7. All right, you want to look at something from chapter 3?
Oh my.
Any suggestions from chapter 3? We had multiple choice questions, forecasting example, forecasting solution, handout, chapter 3 question solution, chapter 3 book problems. Anyone have any preferences? All right, how about I pull up the chapter 3? I don't know what it was. Chapter 3 question. I just pulled up the solution here. Chapter 3 questions. I guess we can do number 1, kind of as a review. That was a good question. All right, so from the income statement, we have revenues or sales. Revenue or sales at 19.8 million. There'll also be some costs and taxes and interests. And eventually we can figure out net income. Also, we've got a balance sheet that shows assets at 14.8 million, debt at 5.6 million, and they don't give us equity, but since assets equal debt plus equity, 14.8 minus 5.6, we can solve for the equity at 9.2 million. So it says, hey, assume the profit margin. Remember, the profit margin was something I wanted you to memorize. If the profit margin, which is net income to sales, is equal to 11%, and we know sales were 19.8 million, we could find net income. Net income is equal to 0.11 times 19.8 million. It's equal to 2.178 million. So we found net income because we knew what the profit margin, meaning out of the 19.8 million, they've got cost, interest, and taxes, but 11% of the revenue ends up as net income. That's what the profit margin or net profit margin tells us. But out of every dollar of sales, they'll have 11 cents of net income, which means they've got 89 cents of costs. All right, they also wanted return on assets. You don't have to memorize this, but return on assets is net income relative to assets. Now that you know net income, 2.178 divided by 14.8 million gives us a return on assets at around 14.7%. Since we also know equity, return on equity, it's getting messed up. Return on equity is net income to equity. Since we know net income and we know equity, I gotta write it down here. It's equal to 2.178 divided by 9.2. Or 23.7%. All right, so this was just looking at the ratios so that we can kind of figure out, given some information, it allows us to sort of like forecast things like sales and a profit margin. That's how we get net income. We could divide it by shares outstanding. That gives us earnings per share. We could figure out how much they're paying in dividends. That's the dividend payout ratio. And you can see how that then allows us to forecast things like the dividend in year one. All right, remember also, we're not going to have sustainable growth or internal growth rates on the test. I'll try to pick it up in a later chapter. All right, something like finding the PE multiple. Let's see if I can. Oops. There we go. All right. So we've got a profit margin, which you want to memorize, net income to sales at 5.6%. If sales are 311,200, you can solve for net income. Net income would be equal to 311,200. Net income would be equal to 17,427.2. Okay. If we want to find the price to earnings multiple, it's really price per share divided by earnings per share. We want to find earnings per share. This is another one you have to memorize. It's just net income divided by number of shares outstanding. We know net income at 7,427.2. The number of shares outstanding is 15,000. That means our earnings per share is equal to $1.16. So if the price per share is 11.60, given up here, and earnings per share is $1.16, the P multiple is 10. All right. Well, we got about 2 minutes left, 2.5. Remember, Chapter 7 quiz due tomorrow at 2. If you need help uploading a file, just call me or text me. I'll walk you through it. Most of you probably done a lot of these things, but you never know. I have not, so, but I can probably help you figure it out. Test to be next Tuesday. I'll send you an email probably on Monday telling you what the format is. I'll probably open the test up, give it to you on Tuesday, but I'm not going to give you like 3 days to do the test. Okay. I'll give you more than an hour, obviously, because there'll be some people that might have time constraints. Okay. But I'll probably open it up and it may be due, I don't know, 11 o'clock at night or maybe like 10 o'clock the next morning, something like that. So be prepared for that. Any other questions? Everyone seems to be doing a lot better at Zoom, including myself. We didn't get logged out, so that was good. All right. Other issues? Anyone have problems accessing the Zoom files? If you want to, I guess if you're here, you probably don't watch them, but, or the YouTube channel. All right. Well, remember, I probably won't post this Zoom thing until 4 o'clock or so. I got a class right after this, but all right. Any other questions? Don't forget about your quiz tomorrow by noon, I think. All right. I'll see you guys Tuesday, test day, or just email you something. I don't know. I might have a Zoom. I don't know what I'll do. All right. I'll talk to you guys later.
Have a great day.
You too.